Okay, welcome everyone. Welcome to the Hurley Investments Market View Commentary for the 18th of March. A couple questions came across to me, so I thought let's get those answered for you. So first question was, would you please explain dollar cost averaging without having to spend more money? You guys may have heard me say this over the life of doing our webinars and so forth. The short answer is this, and I guess it's not a short answer, but it's what I mean when I say we're dollar cost averaging without spending more money. All right, let's say we buy 1,000 shares of a $100 stock, costing $10,000. We then buy a put. We then buy usually it's called a married put, for $5.50 per share. And 10 contracts at $5.50 would be roughly $550. So our total cost basis, and we're going to buy a put at $5 per share at the $100 strike price, which just means we have the right to sell a stock at $100. So our cost basis with protection, and most of you saw us do this when we first put your positions on, is equal to the stock of $10,000 plus the long put or married put cost of $550. So your total cost basis, don't you like that cost basis? Total cost basis is $10,550. So someone tell me, how far down does our $100 stock go? Someone tell me, how far down does our $100 stock go? Give me a percentage. How much does our stock lose? Has a bad earnings? Partially, Abraham, because I don't want to do that number. I mean, you've seen stocks at earnings events. How far does a stock go down? Let's say this stock has an earnings event. It blew it. It's Boeing, right? How far is this stock going to go down with a crappy earnings event? Because that's usually our trigger when we want to protect stocks, when they're most likely to lose, that 15% or more. 30%. Mod says 30%. So here we go. We have bad earnings and the stock loses 30%. So your shares are now worth $7,000, right? Or $70 per share. That's what our shares have lost. Remember, the maximum loss with $100 long puts was the cost of the long puts, $550 or 5.5% of total invested capital. But we had a stock that lost 30%. So here's the math. Here's the thought process behind what we're trying to say in regards to your protection, right? Technically, we can sell the stock at what? $100. Perfect. So I'm going to put this technically speaking, we can sell the stock at 100 and get back our 10K. Because we have the right to sell our stock at a certain price for a certain period of time. Now, what we will typically do is sell this. We'll sell this off when it comes to a support level. We typically don't want to sell your stock for a loss and buy back in, because that creates something called the blue sky rules, and you can't write your losses off unless you wait 30 days and get back in on that 31st day. So typically we will sell those long puts, which give us $10,000 or slightly more. We divide that by the $70 a share, and mathematically, if you take that calculator, 10,000 divided by 70, and all of a sudden we have, got to do my math, 10,000 divided by 70. It looks like we have, did I not do that right? 1,000 shares of a 100, I did not do that right. Got to do my math right, people. It'd be $100,000, excuse me. Let me make some quick changes here, which would be 5,500. It's still close. All right, now that I've done it all right. So if we take 100,000 and divide it by $70, we come up with 1,428.57 shares. Now, typically, we're not going to buy 28 or 0.57 shares, right? We're not going to do that. But we will buy 400 more shares. At $28.57, or that 28.57 shares, is still worth, you multiply it times 70, is still worth about 2,000. But we're going to buy 400 more shares. Divided by 1,400 shares, because we will lose some of that, right? We will lose some of what we paid for. Let's see if I've got it all right. We're going to say we're going to lose, on the worst case scenario, we're going to lose all of that long puts. But our new cost basis is now going to be $75.39 per share. All right, so now did I completely confuse people, or do you get it? Yes, we would buy back our initial 1,000 shares, plus we're going to buy the 400 more. So yes, Maud, but thank you, Russ, for understanding my math. The short answer is we still have the opportunity to sell the stock at $100. And when you sell the stock at $100, or you cash in the puts for the equivalent, you can buy back in and you're good to go. So this is how we are basically, is that how I did it wrong? One more second. I might be finding all kinds of things I'm doing wrong. 10,000 divided by 70. Nope, I'm doing it right. So the short answer is we take that profits from the puts and we're just buying more shares. It's as if we still have the $100,000, but now the stock is at $70 a share. So something to understand. Stock is trading at $70 and we are still down $5.39 per share. That is because there's a cost associated with buying protection. And we have to wait for the stock to get back above $75.39 before we're going to break even. But that sure beats waiting for the stock to get back up to 100. And that's the difference between active management and passive management. And you are correct, Abraham. But this is how we're dollar cost averaging without having to spend more money. Once we get that long put in place, we're selling that long put. That long put might be worth $30,000. Take that $30,000 that long put is worth, divide it by the $70 a share, you come up with $428 a share, or 428 shares, excuse me, and you're good to go. Now, the neat thing, hardest job of investing, patience, or waiting for things to come back. What if the stock at the next earnings comes back to $100? What if at the next earnings the stock comes all the way back to $100 per share? 1,400 shares times $100, and all of a sudden you have, can't see because I've got GoToWebinar in the way, all of a sudden you have a price of $140,000. Everybody else is just waiting to break even, and you're going to make a 40% return on a drop in of stock of 30%. Now, Abraham, some of your math is off because you had that cost of that stock being at $100,000, but the cost of the stock will only be at $70,000 now. And then you add in the, you know what you made on the puts. Perfect. So here's a couple more questions that came in. If a put costs $550, how much does it increase in value as the stock decreases? So the short answer is you're now talking about intrinsic and extrinsic value. So intrinsic. Boy, I really wish I could just get rid of all these. Intrinsic equals in the money. So if you have the right to sell at 100 and the stock is trading at 70, that equals at least $30 of intrinsic value. So your long put is at least worth at least $30 of intrinsic value. The extrinsic, I just cannot spell or type worth beans today, is the extra or time value. So if we bought a put 8 weeks out in time at $100 at the strike price, it just pegged, that would equal that $5.50 per share. And every day that decreases by a nickel until the last week, then it decreases by a quarter each day. That comes into the delta and the theta and the beta and the gamma and all the different pieces of the stock. And I'm not going to go through that too much, Russ, but that's the idea on that put. And usually that time value somewhere between 5 to 7%, maybe 4.5 to 7%, depending if you go out 6 weeks to 3 months. At 6 weeks, it's going to be between 4.5 and 5% of the value of the stock. If you go out 3 months, it's usually going to be about 7% of the value of the stock. So that's the time value. There's also something called volatility crush, that sometimes the price of protection gets really expensive in the month of options expiration, which is why you want to go out an extra month or an extra couple weeks. So you won't have a big decrease after the earnings event. Usually long puts do not work really well being 4 weeks or less. But great questions. I have a couple people here. Jim, is this making some sense to you? Both Jims, Bossermans, is this making sense to you? And Russ, was this making sense to you? And kind of is a good answer, because we'll keep going through this throughout the year. Thank you, Kohler. Bosserman, how about you? And Russ, did I get your questions answered satisfactory? Thank you, Russ. All right, Bosserman, still waiting for an answer from you. But this is how we dollar cost average. We have the right to sell it at a higher price. Technically, we could sell it, but that doesn't make sense because if you sell it and then buy back in before 31 days, you lose your loss on the stock. Perfect. Thank you, Bosserman. And so you just sell the put, you take those profits from that put and you convert it into more shares of stock. But it's pretty neat how a 30% loss on the stock can get you 40% more shares of stock because you're now buying that stock back at a cheaper price. So it's kind of interesting because sometimes people forget this, right? If you have, for every dollar in the stock market, if it gains 50%, loses 50%, or vice versa, loses 50% and gains 50%, how much is your dollar worth on a 0% return? Again, do that math one more time, right? Every dollar you have in the stock market, if it gains 50%, then loses 50%, or vice versa, loses 50%, then gains 50%, on a 0% return, how much is every dollar worth? Well, for every dollar, you have a dollar. It gains 50%, it's worth $1.50. It loses 50%. Well, now it's only worth 75 cents. Well, let's do it the other way. We have a dollar, it loses 50%. It's worth 50 cents. It gains 50%. Well, crap, it's still worth 75 cents. We're taking advantage of that because we're buying stock at a lower price than what we bought our original stock. Yet we still have, in essence, that original capital investment. So the next question is normally, well, won't it be more expensive to buy puts next time? It's kind of funny because the answer is usually no. Those puts are going to be around $5,500, but instead of being at $100 to protect it, our next protection will be at $70. And instead of costing $5.50, it might cost $3.75. But we now have to do it for 400 more shares. So the price will still be pretty close to that $5,500 every single time as it's going down. And again, if we can put this into a perspective, if it loses 30% 3 more times, or let's say it 3 times total, if it loses 30%, if it loses 30% 2 more times, that means the stock goes to $49. And this has happened kind of over and over again. And then to 49 times 0.7, then it goes to $34.30, right? You already know you're going to gain about 40% more shares of stock. So if it goes down to $49 a share, 1,400 times 1.4, you're going to be somewhere around 1,900. It should be 1,960 shares, but we'd be at 1,900. 1,900 one more time. $2,660, but we would be at 2,600 shares. And then let's do the math all over again. let's just say, and now the stock only goes back to $70. Multiply that times 2,600 shares and just do the math. This is simple math. They're going to be worth $182,000. Two really good questions came in regards to this. All this is with the assumption it will rebound and not so far away in the future. So it's not the assumption, it's doing the math and the due diligence so that you can prove the fundamentals are still in shape. Abraham says a bit of faith is still needed. No faith. Don't bring religion into the stock market. There is no religion in the stock market except to screw you over. This is all about working the numbers. Could it be that pieces of their plane are blowing off? Yes. Could it be for Meta that they had an owner that was blowing tons of money in virtual reality, like over 10 billion a year for 2 years, and the stock tanked and lost 75% of its value, or lost 30% through 4 different earnings? But now the stock is back up to $500 for Meta. And on Meta, we basically doubled the share count off of only 300 shares, which means the stock had to lose 33% or more of its value 3 times in a row. It did. People are like, you idiot, what are you doing? We're like, hey, it's still bringing in $12 billion a year, even after wasting $10 billion a year. The fundamentals on Meta still said it had upward growth. So we stayed with it. And the assumption is in the not so far away future, Abraham, this is investing. For Meta, it was 2 years and like 2.5 years is the process. But that 2.5 years created basically, you know, 166% return or a 266% return, depending on how you do. Learn that Meta cannot be bought by anyone if market does not allow it. You know that? So the short answer is, no, I do not know that. In fact, I would disagree with that 100%. Microsoft isn't controlling Meta at this time. I'm buying and selling Meta as we speak. Okay, second question that came in. What are we in right now? And I'm thinking the question is stock pricing cycle. And so the short answer is, and if I misunderstood this, please step in and respond. I couldn't tell you because there's so many different stocks. What I can tell you is the market is still bullish. Some of our stocks are bullish and some are not. So the simple answer is, for those that are not bullish, we are waiting. We're waiting for them to move higher. Those stocks right now would be considered Bank of America, Boeing, Baidu, Disney, Ford, Square would be one. Under Armour would definitely be one. Some have moved. And just in general, Apple, Meta. I'm going to change a couple of these. I'm thinking of other ones. We are waiting for Micron to move. JP Morgan has moved. MRO has moved. We just got an MRO between $21.50 and $22. MRO right now, unbelievable stock. MRO today is trading at, well, it closed at $26.59. I did see it up at $26.50. We got in at this sucker right in this time frame. We did amazing for MRO. It's moved. Can it still move farther? Yes. Is it overbought? Yes. With that said, we've let MRO, for the most part, run. In fact, right now, stocks, wish that T key would not stick. Stocks with protection are only Under Armour, and it's at $9. Square has protection on it. Disney has protection at 110, and Boeing, for those few that are in Boeing, has protection at 205. So we're letting stocks move without protection. MRO is a great one. We did run it through an earnings event. The question keeps coming up, how did you know? We didn't necessarily know. Again, it just comes back down to doing your research, so you can say, hey, something's undervalued and it should move higher. Doesn't mean it's going to, but it could and it might. I mean, that's really the short answer. Okay, here we go. For this week, anyone know what's happening this week? Anyone know what's happening this week and what we're going to pay attention to? Fed meeting, there you go. Federal Open Market Committee rate meeting. I'm going to go out on a limb, not cutting rates. I also got and say July looks like the first cut due to Powell's GOP, what would you call it? GOP testimony. Looking for 3 months, and probably not going to happen. Which means, yes, we're very bullish on stocks right now. We're letting some run, but we will definitely be paying attention to Wednesday and the market reaction, which means we probably will expect a pretty muted day tomorrow. There's not a whole lot going on tomorrow. Housing starts and building permits, that's really what we're looking at for tomorrow. FOMC rate decision on Wednesday. So I would not think that plain and simply, I would not think that the market's going to move a whole lot tomorrow. Pretty muted, probably same thing on Wednesday. And it depends how the market digests the realization that, we might not get a rate hike until farther into the cycle than we expected. I think we were telling everyone, hey, no way it's going to be 5 to 6 rate cuts at 2%. We're lucky to get 1%. So pretty tame week. Micron reports Wednesday after the market closes. Lululemon and Thursday with FedEx. Not a whole lot going on. We're obviously going to be a news-driven market, and boy, today was a great day. Today we had Google move. For those 4 or 5 that are in Google, short puts expired at 150 on Friday, moved up and touched 150, couldn't get higher than that today. Well, couldn't hold the gains higher than that today. Finished at 147.68, and Google will probably meander between 145 and 152 till the next earnings. Someone typed in NVIDIA. NVIDIA is kind of too rich for our blood, but NVIDIA was up $6.18, trading at $884.55. It would be really smart for NVIDIA to split their stock price. To do a 10-for-1 split would work miracles for NVIDIA to keep going higher. But right now it's in that frame where it is overbought, and you'll see it selling because it's too much of individual funds and portfolios. So kind of like Warren Buffett, you'll just see it start to sell off. I probably would not expect to see it go much higher. In fact, if anything, it'll probably go down and touch 700 before it'll touch 900, as it'll become too much of mutual funds and so forth, and you'll see it starting to sell off. Okay, couple interesting articles for you guys. Talk of recession is dying down. In fact, I would say a recession is off the table for 2024. How do I say that? We don't look like we're going to have 2 negative quarters in a row, which is the definition of a recession. So I do not see a recession in 2024. Really interesting article that, hey, recession seems to be off the table. China numbers came in much better than expected. This is something that we can see for growth in China. I don't know how much they can grow this year, but what I do know is that they really got their butts kicked last year. So I kind of feel, and I don't have the numbers to back it up, but I bet if I did a little bit of research, China would be a spring that's just loaded and compressed, ready to bounce back higher. A lot of you are going to say, oh, you're just hoping for that. The numbers say otherwise. The retail sales, the fixed investment, what other countries are pouring into their country right now. China is a spring ready to explode higher. Please read through the article. Alphabet shares 7% on Apple, is in talks to license Gemini AI for all iPhones. It's really a way for them to play nice, to not have to pay the $2 billion to Europe, where they're now going to say, hey, we're letting other things into our iPhone. Watch it really slow down Apple and screw up their iOS system. They should just stick to their guns and tell the European Union tough, but they don't have the you-know-what to do that. And then I found a pretty interesting article in regards to what jobs are paying very little after a 4-year degree. There are 2 different charts for the low end and the high end that are in here. The worst paying ones were liberal arts, performing arts, theology plus religion, leisure and hospitality, general social sciences, history, miscellaneous biological sciences, fine arts, treatment therapy, nutrition sciences, psychology, anthropology, family and consumer sciences, social services, elementary education, early childhood education. Those are at the bottom of the barrel for education and getting your money's worth. Then the mid-career workers who graduated, early childhood education or education in general is at the low end, meaning general, elementary, secondary, and miscellaneous education, social services, theology and religion, special education, family and consumer sciences, performing arts, health services, nutrition sciences, psychology, anthropology, liberal arts, and foreign language. So just something to think of if you have kids or grandkids that are going through college and what they're going to need to do to maybe make a better living or make the living that they want for their lifestyle. It might be the best way to say that. With that said, what questions do you guys have for me today? So yes, right now, some of our portfolios in the wait and see, some of our portfolios are getting to fully valued where we're looking to take profits off the table. So excuse me if I didn't answer that question correctly on what cycle we're in. Different parts of the portfolio are different parts of the cycle. There's some stocks that are fully valued, close to fully valued. There's still some stocks that are not anywhere close to being fully valued. So we have some, I don't have a great answer for what part of the cycle we're in, because I maybe don't understand the question completely, but that's in general. Some stocks we're in a wait and see. We're waiting for some things to come back. Some stocks we're not. Thank you, Russ. Any other questions, or should we call it a day? And again, I'm just trying to answer questions that you guys have coming over so that I can give you the best educated decision on what we have right now. Thank you, Russ, for the correction there. All right, in that case, let's wrap it up and call it a night. I appreciate you guys being here. I hope this was helpful for you. If you do have questions that you'd like in these type of settings, please just send an email and I will try to incorporate it in some way, shape, or form into a market lesson so that we can better understand, we can learn from it. Guys, have a wonderful evening. Maud, I'll give you a call back here shortly. Thank you very much. Have a good night, and I look forward to seeing you guys on Thursday. Bye-bye.